suddenly the Sharpe ratio matters. I guess beta matters again, but outside of beta, we've got the risk-free rate, and it is returned with a vengeance. Are we revisiting the Sharpe ratio? Are we back to the articles you wrote for the CFA years ago?
Tom, wonderful question, and I'm going to respond by giving a bit of a prologue, which is that many models are broken, have been broken during this period of time because they typically respond to cyclical phenomenon. For example, your question to Michael before about the Phillips curve. And the reality is that there are so many structural changes in the economy and the markets as well that a lot of those models simply have not applied. Some of them are coming back in force. The Phillips curve, for example, had no way in its model to reflect the fact that there was a pandemic, that we have had this generational shift in labor force participation, by which I mean the baby boomers are now stepping out of the labor force. And the other thing, of course, is that we have had a 4-year deceleration, if you will, in terms of immigrants coming into the United States. And over the prior decade, immigrants filled 60 to 65% of the increase in employment in the United States. So there are a lot of things that are different. Within the market itself, a lot of the models haven't applied for a while. Keep in mind this weird 20 to 30-year period in which interest rates and inflation were extraordinarily low. And to your point, real rates reached negative levels, something we had never seen before. I, for one, now I'm answering your question, I'm happy to see that the Fed is now focused on making sure that real rates, real yields are in fact positive. And does the market believe them? And the reality is that we now have a flat to inverted yield curve, which suggests to me that bond investors, at least, are giving the Fed credence and credibility in terms of believing that the Fed policy will have efficacy.